Hi everyone, welcome to module 3 of our SaaS FP&A series. Today we are going to discuss CAC and LTV in detail, the unit economics that determine whether a SaaS business is fundamentally healthy. A company can have great ARR and great NRR and still be burning cash unsustainably if its CAC exceeds its LTV. So let's break it down together. First of all, we need to understand what is CAC. CAC is customer acquisition cost, that is the total cost to win one new paying customer. So, in simple terms, you can say that CAC is every dollar you spend on sales and marketing divided by the number of new customer. So, basically, you're trying to figure out how much you have spent on one customer to acquire that one customer. Formula for this is CAC is equal to total S&M spend divided by new customer acquired. Again, one thing to note here is we only consider that new customer acquired when they go live, not when the contract happens. So, what is included in CAC? We include salaries, commissions of the sales team, marketing spend, tools and softwares, recruiting costs for sales hires, customer success and onboarding cost. For example, our S&M spend is $120,000 and new acquired customers are 40. So dividing both the numbers, we get 3,000. So on each and every customer, we are spending 3,000 to acquire them. Let's look at this Excel example of CAC and how we calculate it. Here we have different spend categories in CAC through salaries, commissions, marketing campaigns, SEO, events and trade shows, CRM and sales tools, customer onboarding, or customer success cost. So, to get the total S&M cost, we'd simply sum the above values, which is coming out to be 45,000. Here we have new customer which are 15. So, our CAC would be 45,000 divided by 15. So our CAC comes out to be 3,000, which is how much money we are spending on each customer to acquire them. Next, we can also calculate S&M as a percentage of revenue, which is nothing but you're trying to figure out how much expenditure on sales and marketing you're having as per the percentage of your revenue. So you can simply calculate it by 45,000 divided by, let's now take our revenue to be 5,000. So our S&M expense as a percentage of revenue is 900%. Now also look at one more component of CAC, which is fully loaded CAC versus lightweight CAC versus standard CAC. So CAC can be divided into three categories. First one is lightweight CAC. In lightweight CAC, we only consider marketing expenses. Why? Because we want to have a quick ratio for so that we can understand how our CAC is performing. It is generally used by the marketing team and it is generally not preferred by the investors as one of the KPI to be presented in the board meetings. Next one we have is the standard CAC, where we only take into consideration sales and marketing expenses. This is again used by the company in case if they want to have a quick go around how their sales and marketing spend are doing with respect to the customer acquisition. Next, and the most used one is fully loaded CAC. One thing to understand here is investors always want to know the fully loaded CAC, not your lightweight CAC or standard CAC. What is the difference? In fully loaded CAC, we have the component of lightweight CAC, standard CAC, but with that, we also have the component of CS onboarding, which is customer onboarding or customer success cost. So, it is more accurate and it is the one that investors want to see. Moving on, we have LTV. So, LTV is the lifetime value of the customer. So, it means that how much profit a customer is generating over the entire relationship or over the entire time it was with you. So, it has three components. So, let's understand those three components first and then we will get back to the formula. So first of all, we have ARPU, which is average revenue per user per month. So it shows us the average monthly subscription fee across all active customers. Then we have gross margin. Gross margin is revenue minus COGS. So for SaaS companies, it is typically 60 to 80%. Then we have churn rate, which we have already discussed in our previous videos. So now let's look at the formula. So LTV is equal to ARPU into gross margin percentages divided by churn rate. So what is happening here? We are trying to figure out from the revenue what is our gross margin percentage. So here what we are trying to do, we are trying to multiply our average revenue per user into gross margin percentages so that we are able to get how much actual profit we are making. That is our gross profit. And then we are dividing it by churn rate to get to our lifetime value. Now let's look at one example, which is our ARPU is $200 per month, our gross margin is 75%, our monthly churn is 2%. So LTV would be 200 into 75%, which gives us our gross profit, then dividing it by 2%. So from that particular customer, we will be able to get 7500 as our LTV. Now, one thing to note here is why gross margin and not revenue? Why take this gross margin at all? Why not just use ARPU divided by churn rate? Because if you use revenue, you're not counting money you spend on the hosting or support as profit. LTV must reflect what actually flow through the business after direct costs. So, what it means by taking gross margin and not only revenue, we are trying to deduct all the expenses that we have made to reach here. Now, let's look at how we can calculate our LTV, which is customer lifetime value. In this example, we have our ARPU, which is $200. Our gross margin is 75%. Our monthly churn rate is 2%. So, first of all, since we are going to calculate our LTV on the annual basis, we first of all need to have the annual churn rate. To calculate that, the formula is mentioned here. We just need to use the same one. 1 minus 1 minus monthly, which is 2%, 2% to the power 12. So our annual churn rate comes out to be 21.5%. Now we need to calculate our average customer lifetime in months, which is simple. We just need to 1 divided by monthly churn rate, which comes out to be 50. Now we need to calculate LTV. So now we need to calculate our LTV. So how we will calculate our LTV? ARPU divided by our churn rate. So is it correct? No, it's not correct. Why? Because we are only taking revenue. We are not taking into consideration our gross profit. So what we would do here, we would calculate it again. We would take into consideration our ARPU, multiply by our gross margin, and then we will divide it by our monthly churn rate, which comes out to be 7500. Next, we need to calculate annual gross profit per customer. So now we are trying to calculate the gross profit for annual basis. So it is very simple, 200 into 75% into 12, which comes out to be 1800. So in an year, if we go by the same rate, we will be able to earn the gross profit of 1800. So now we can calculate LTV using the annual churn value that we have already calculated, which comes out to be 1800 divided by 21.5%. So our LTV on an annual basis would be 8,361 rupees. So in case if you want to show the LTV on the monthly basis, it's 7,500. But if we have to take into consideration it in the form of annual, it is 8,361. Now let's talk about LTV is to CAC ratio. It is one of the most important unit economics metric for SaaS investors. It is calculated as LTV divided by CAC. Now let's understand what it actually shows. It shows us every $1 spent on CAC should return 3 plus dollars in gross profit. So what we are trying to say that we are trying to say in case if we are spending $1 on SMN or any kind of marketing or sales activities, we should at least get $3 out of it, the three multiple of it to sustain a good business. So the target LTV to CAC ratio is 3x. However, we have different benchmarks which are mentioned here. If your LTV to CAC ratio is less than 1x, you are in the danger zone. You are losing money on every customer. If it is between 1 to 2x, you are in the warning zone. This means you do not have enough return to sustain your business and you are quickly running out of cash. Then we have 3x, which is the target. So it is the standard benchmark which every SaaS companies try to follow. It is a healthy and scalable benchmark. If your benchmark is more than 4 and less than 5, you are in the strong position. You're doing good with your CAC, LTV, and everything, and you're good to grow more. If your LTV to CAC ratio is more than 5x, it means you are in the elite zone, which means you are a world class player and you're doing superb in the market. Now, let's talk about CAC payback period. It means how many months until a customer pays back what they cost to acquire. The formula for it is CAC divided by ARPU into gross margin, which is nothing but is CAC divided by profit. So, what we are trying to achieve here is after acquiring a customer, how many months will it take to earn back the money we spent to get them? So, the lower the better, because if we are able to get our money back in the lowest time possible, we are doing good. So, let's understand what is the basic difference between LTV to CAC ratio and payback period. So, what is happening here? LTV to CAC is a ratio. It tells you the magnitude of the return per dollar spent. It helps in the long term assessment. Plus, it is sensitive to churn rate. But in case of payback period, it is like a clock. You're trying to understand how much time will it take to break even? How much time will it take for you to get your money back where you have no profit or loss with that particular customer? A very easy way to understand this is think of buying a rental property. You invest 10 lakh to buy it. It generates 1 lakh rent every year. It will take 10 years to recover your investment. So, in this scenario, CAC would be money spent to acquire a customer. Monthly gross profit is the rent received every month plus CAC payback period would be the time taken to recover the acquisition cost. This is a very simple and important concept which is looked at by each and every investor. So now we have a general benchmark as well with the GTM model. GTM is nothing but go to market model. If it is less than 6 months, very good. If it is between 6 to 12 months, still we are in the target benchmark. If it is between 12 to 18 months, it is still in the acceptable range if you lie in the mid market segment. If it is 18 to 36 months, okay, but your LTV is massive, then you are in the danger zone if you're taking more than 3 years to recover your CAC value. That means you're having unsustainable business without huge deals. Understand LTV to CAC ratio and CAC payback period with the help of an example. Here we have different parameters like ARPU, gross margin, monthly churn rate, S&M spend, new customers per quarter for 4 companies, ABC and your own company. So let's calculate it. First of all, we need to calculate the CAC. CAC is nothing but your marketing spend divided by your new customers. So this will be 60,000 divided by 80. One thing to note here is we want it in the monthly terms, but here we have both the values in quarter. So we will divide it by 3 as well to get the monthly value. Next, we need to calculate customer lifetime in months. To calculate it, we just simply need to divide it by monthly churn rate and we get our customer lifetime in months. Now, if we have to calculate our LTV, what we have to do, we have to divide our ARPU into gross margin with monthly churn. So, we will multiply ARPU with gross margin, which will be then further divided by our monthly churn, which comes out to be 3500. Then to calculate CAC ratio, we already have it calculated LTV divided by CAC, which comes out to be 1.6 multiple X. Now, to calculate CAC payback in months, first of all, we should calculate monthly gross profit, which is very simple. We just need to multiply 150 with our gross margin to get our profit or loss value, which comes out to be 105. Now, to calculate our CAC payback period, what we have to do, we have to divide our CAC with the monthly gross profit or loss value. So, This means we will be able to get back our money in 21.4 months. Now we can simply drag this formula towards the end to get all the table filled out. Here we can see that as per LTV to CAC ratio, company C is doing great, whereas our company is performing very poorly. In case of CAC payback, our company is again doing very bad. The best company performing here is company A. Now let's talk about blended versus segmented CAC. Why it is always preferable to calculate segmented CAC instead of blended one? Because averages always lie. So, truth always lies in the unit economics. So, basically, what we are trying to say here, if we take the summation of all the S&M expenses and then calculate the CAC and your LTV to CAC ratio, you won't be able to understand how each and every channel is performing separately. So, your blended CAC might not be able to give you the true picture. So, it's always recommended to calculate CAC segment wise, which is by channel, customer size, cohort wise. Let's understand this with the help of an example. This is an example where we have channels, S&M spend, new customers, CAC value. CAC is nothing but 15,000 divided by 30 and so on. Average LTV, LTV to CAC ratio. So, what is happening here for organic slash SEO? Our LTV to CAC ratio is 18x, which means we are doing good and we should scale this platform more. Then we have paid search where we are getting 3x as our LTV to CAC, which means we should at least try to maintain it. Then we have event slash field where we are getting 5x, which means we can invest more to gain more value. Now, in case of outbound SDR, our LTV to CAC ratio is 0.9x, where we are not performing very good. So, the ideal suggestion or recommendation here would be to stop this channel entirely. But now, if we look at the blended total, the blended CAC, what we are getting 4.7x. If we only rely on this, we would continue with current group of CAC spending. But if we look at each and every segment, we are able to understand that organic is performing very well and outbound SDR is performing poorly. So it's always recommended to take into consideration segmented CAC and not the blended one because it's misleading. Moving on, we have three common CAC and LTV mistake. The first and the most common mistake that everyone makes is using revenue instead of gross profit in LTV. We already looked into this problem in the previous slide. We saw that if we take revenue instead of gross profit, we won't be able to take into consideration the expenses that the company is making. So it's always recommended to multiply by gross margin and not take into consideration just the revenue. Another common mistake is excluding customer success and onboarding costs from the CAC. Generally, whenever we quote the formula for CAC, we say sales and marketing expenses. Therefore, what happens a lot of time people miss out on the expense of CS and onboarding for new customer. So we should always take into consideration these costs as well. So basically, CAC should always include all the costs that are required to be spent on the customer. Then we have another common mistake, which is using blended CAC without channel segmentation. We already discussed this in detail in the previous slide. Why not use the blended one? Because it does not help in the decision making. Now we will talk about what drives LTV. Three levers. There are three things that we can do to improve our LTV. First one is increase in revenue. If we are able to increase our revenue, we are able to increase our LTV. How we should do price increases, upsell, cross sell, expansion, or try to bring in new product tiers so that ARPU, our average revenue per user, can be increased. Another one is improve gross margin. There are two ways to improve gross margin, either increase revenue or decrease your cost. Since we have already discussed increase in revenue, here we are discussing decrease in your expenses. So try to do more automation, bring in more efficiency in terms of engineering and infrastructure. Next one is reduce churn. Here we are trying to reduce the customer who are exiting our business. So we should do some strategies or some tactics so that the current customers stay with us for a very long time. This will help us increase our LTV value. On other hand, it will also help us with better NRR and GRR as well. here we have the key takeaways from our entire session. But stay tuned for more because we will be discussing more KPIs in the SaaS business and why they are important. So, thank you. Have a nice day from Nerd It Off.